Yes, the big event in 24 hours, the FOMC meeting, which is currently underway, will be watched not just for the rate action, but more for whether it will confirm a pause after the current meeting. A CNBC poll has indicated that 72% expect a rate hike tomorrow and 86% expect a pause from the next meeting and not just in the next meeting. To parse the US rate scene and its impact on emerging markets, I am joined by Aditya Bhave, Senior US Economist at Bank of America Securities. Aditya, good evening to you, and thank you very much indeed for staying up for us. I think it's almost night. Well, what are you and Bank of America expecting to hear from the FOMC tomorrow?
We expect the Fed to go 25 basis points. That's pretty much priced into the market. The more interesting question is what they signal about the June meeting and the path of rates going forward. We think that they'll signal a pause as the base case scenario, but they'll keep the path, they'll keep the door open to further hikes, essentially signaling a weak bias to hike rather than cut going forward.
Okay. Aditya, the CNBC US poll itself indicate that 86% are expecting a pause hereafter. So the question is, will they definitely indicate a pause?
Yes, that is our base case. We think that they'll use language such as further rate hikes might yet be appropriate, suggesting that they're expecting to pause in June, but they still keep the option open to hike, because let's remember that there are two more jobs reports, including the one on Friday, and two more CPI reports between now and the June meeting. So if those data come in strong, and if at the same time there are concerns about financial stability around regional bank stress, those concerns somewhat subside, then they might well end up doing another 25 basis points in June.
So they are not going to indicate that we will definitely not hike anymore. Will that kind of a assurance come?
Yes, again, we do think that that is what they'll signal. We think that they'll signal that their expectation for June, as of now, is a pause, right? But they're not going to close the door completely to additional rate hikes, because they know they're somewhere close to the end of the hiking cycle, but turning points in the economy are difficult to call in real time. And what they don't want to do is leave the job unfinished on inflation.
Okay, so what you're saying is that they will indicate a pause for next meeting, but not a permanent pause. Okay, when do you think the Fed may start cutting rates?
We think the first cut will come in March of 2024. That being said, there's significant uncertainty around this view. So you could easily make a case where the first cut comes a little bit earlier, let's say towards the end of this year, depending on what the downturn looks like. We expect a recession to start in the third quarter of this year, but we think it'll be somewhat mild. So if the recession's a little bit worse than what we're expecting, if inflation comes down a little bit faster than we're expecting, or if financial stresses build up to a greater degree than what we're expecting, then you could see the Fed cut a little bit earlier. But for now, our base case is that they go in the first quarter of next year, by which time core PCE inflation will be around 2.5% on a year-over-year basis, and they'll feel confident that we're heading back towards the 2% target.
You know, that's the point. The Fed has to keep its eye on inflation, and not the entire market believes that 2.5% will come. There are a lot of people who believe inflation may not fall below 3%. What do you think are the chances that inflation won't fall?
Right. So inflation has been sticky for a couple of reasons. On the one hand, if you look at the good side of the economy, then supply issues persist. So we've gotten disinflation in goods, but we haven't really gotten deflation outside of used cars, certainly not to the degree that we would have expected it a few months ago. So that's one concern. And then when you look at what's going on with services, a lot of the inflation seems to be driven by very, very strong demand. That's what our analysis suggests. So we kind of need both of those factors to resolve themselves. And on the demand side, the way in which demand decelerates, unfortunately, is for the economy to first slow down and then inflation as a lagging variable to drop closer to the Fed's target. So you first need something like a recession, and then you get inflation under control. If you don't get that recession, if the economy continues to chug along, then sure, the risks are that inflation could remain stuck around north of 3%, which would be too far above target for the Fed to feel comfortable.
Okay. So in that case, what is your base case of economic growth? When and how intense do you think the recession will be?
Our base case is that a mild recession will start in the third quarter of this year. It'll be about less than a 1% contraction from peak to trough in GDP. And to put that in perspective, that's about half the size of normal average post-war recession. So it's a mild recession, but it is necessary to get inflation back down. We have the core PCE coming down to the low threes at the end of this year and down back to target at the end of next year. But that's premised on the recession actually happening.
And is there a downside risk to your growth forecast because of the banking crisis that's expected to crunch credit even more?
Yes, before these banking sector, these regional bank stresses emerged, we would have said that the risks to our forecast were more in one direction, more towards a potential no landing scenario rather than the recession that we have in our forecast. But now I think the risks are more evenly balanced, where on the one hand, I think there's still a chance of no landing, and on the other hand, there's a chance of a deeper recession than what we're forecasting. The key is, and I think the Fed has been very honest about this, that we don't know how much credit tightening will happen. We all expect a certain degree of tightening to happen, just as a function of the stresses that have already emerged, right? It's not anything to do with potential new stresses, but we don't know how much credit tightening will happen, and we don't know when that will impact the economy and by how much.
Okay. Now, if we can come to emerging markets like India, what do you think will be the impact of a sustained US Fed rate of 5%, a likely mild recession, and inflation kind of persisting? What's the impact of all this on emerging markets, especially India?
Right. So I think there's a few things to consider there. In terms of GDP, you have to think about exposures to the US versus China. India's relatively less exposed to both economies. But if you think more broadly about emerging markets, the ones that are exposed to China will benefit, that are exposed more to China than the US will benefit from the reopening boom in China. The ones that are more exposed to the US will be probably negatively impacted by the slowdown in the US economy. In terms of rates, the markets are expecting that they're pricing a more aggressive cutting path than what we're forecasting. So if we're right, then the markets will have to price up the path of policy rates a little bit, and that could be bullish for the dollar, which is always not great news for emerging markets.
Okay, yeah, so there are more hikes than a stronger dollar. But what will the trajectory of the dollar be? Does it go below 100 now, sustainably?
Well, the dollar has most likely peaked out. I think we can be pretty confident about that because we've gone through the roughest period of Fed repricing. My concerns on the upside for the dollar would be, one, it tends to perform well when risk assets are in trouble, and that could be the case if we get news that's consistent with the recession, right? It's not clear that risk has priced in a recession at this point. And then two, as I mentioned earlier, if we price in a higher path for Fed funds because the Fed isn't cutting as soon as markets expect, then that could mean a little bit of upside for the dollar as well.
Okay. Now, for the more crucial question for our viewers, what is smart money likely to do? Going by your reply, EMs are going to be less hurt. So do you think more money moves to the EMs?
I'm not an asset allocation expert. I will say that our emerging market economists are cautiously optimistic on EM, but as we always say about EM, it's difficult to think of it as one asset class. Every country has its own idiosyncratic strengths and challenges. So, thinking about it as an asset class is useful in some ways, but it can be a little bit misleading in other ways. And I think especially in this situation where some countries are going to be more exposed to China, that's reopening quite quickly. Some countries are going to be more exposed to the US, and some to Europe, which faces its own unique sets of challenges and opportunities. I think, it's very much a case-by-case story for emerging markets.
Oh, yes, that of course. Now, I don't know how closely you watch the Indian economy, but what is your assessment of Indian economic growth?
To the extent that India is generally a closed economy, it probably has less to gain from China's reopening and less to benefit from, or less downside rather from, the US's expected slowdown. That's the way I would think about it.
Okay. Well, let me come to the last question really on accidents. Can there be a credit event like SVB or First Republic, or even among the non-bank finance companies? Can there be a major default event which can disturb markets?
That's probably more of a question for a banking analyst. I'm not an expert on individual firms. I will say that we're going through a period where the Fed has hiked very aggressively, and to a significant degree, they've done about, as of tomorrow, we expect them to have done 500 basis points of hikes over, I believe, 9 meetings. So our view for a while has been that if they're going at that pace, that can cause some disruptions in the economy. So we've seen certain disruptions, and we wouldn't be hugely surprised if there are further disruptions. But again, our base case is that whatever happens, it'll be relatively mild from the perspective of the broader macroeconomic impact, and that the Fed, given that it's largely caused some of these issues, it does have the tools to mitigate the downside if it feels the need to step in.
All right. We'll leave it at that, Aditya, and we'll touch base with you after we know what the FOMC does and says. Thank you very much for staying up for us this late and analysing the FOMC's likely moves. Well, I must add that both the rupee and the Indian bond markets are in ship shape, in very strong waters. I think the bond yields are the lowest in a couple of years. And that is the reason why you're seeing infrastructure stocks and realty stocks doing very well. Cost of capital within India is clearly falling. We'll wrap up on Bazaar on that note. Chartbusters in a minute after the break.